With the lack of new discoveries and the shift away from growth-focused strategies, the world's major gold miners have seen their economically mineable gold reserves decline over the past 10 years. David Garofalo, Chairman and Chief Executive Officer of the Gold Royalty Corp, talked about the gold mining sector's existential issue of dwindling reserves. On his views about Bitcoin being responsible for gold's low prices, David says that cryptocurrencies capture the younger generation's attention as potentially a reserve currency, and there is a need for a reserve currency in this environment where there's massive quantitative easing, very low interest rates. But what the cryptocurrencies don't have is 1. Barriers to entry, 2. Any physical properties. There's nothing that will prevent somebody from creating another cryptocurrency to capture the market share. And the fact is, it's not backed by anything. Basically, it's digital, which means it's 0 and 1s. There's nothing physically backing it. But according to David, investors will come back to gold. There seems no end to quantitative easing anytime soon and no interest rates coming up. There's still going to be a massive amount of investment, and central banks will continue to diversify out of paper currencies, not in the cryptocurrency, but in the gold. Talking about Wall Street's embracement of Bitcoin, David explains that they are just following the trend. What they are offering is a product that people are buying, but it's still not replacing gold as a reserve, both for central banks and for sophisticated investors that realize they want currencies and preserves of capital that has physical property, something they can use to buy other paper currencies, to buy things. On the current state of the mining industry, David believes that there are very few players left in terms of the large cap gold producers, and it's unlikely that you will see consolidation among them. You'll see a much larger prospect or more significant potential for consolidation in the mid-tier. There are a lot of producers in the mid-term in the emerging producer space within the gold sector, and the reason they are going to do that is to capture the imagination of general investors. They are going to have to achieve scale. They are not going to be able to do it through the drill, but because reserves in the industry are down about 40% over the last 7 years, so we are going to achieve scale to track that incremental investor. So we are going to achieve scale to track that incremental investor, that generalist investor. They are going to have to do that through an M&A, and we have seen some evidence of that in the last couple of years. Even in the absence of the ability to do physical due diligence, we have seen M&A in the mid-tier, in the emerging producer space to achieve that scale. With a 40% decline in reserves over the last 7 or 8 years, if you are not finding it, you are going to have to buy it, and we are seeing evidences of that. Seniors are starting to pick up and talk in some earlier stage development opportunities to populate their pipeline. So the juniors are becoming quite vital to deal with the existential crisis the gold industry is facing with reserves declining. That declining in reserves isn't because metal price assumptions have changed simply through depletion. We are mining as an industry 100 million ounces of gold per year. We are certainly not finding that number of ounces to replace what we are depleting on an annual basis. So we are going to have to rely on the juniors to be successful on the expiration side and the early stage developers to make a strong investment case for their opportunities, so that the seniors and the more mature mid-tier producers start to tuck these in and start to put some capital work in developing new capacity. The gold price is largely driven by demand more than supply issues, and what's driving demand right now is gold is a currency, and currencies trade relatives to each other based on relative interest rates. Gold yields 0, and the fact is sovereign debt yields negative in both real terms and in many cases nominal terms. So that's driving demand for gold. Supply helps with the sentiment and we have achieved peak gold supply in the industry. Now David said that supply helps with the sentiment and we have achieved peak gold supply in the industry. But the supply issue is real and it does drive sentiment positively towards gold. There will be significant discoveries in the next 5 years. That's because we are putting capital into the ground finally. A little over a year ago, we started to see capital flow back into the junior sector. Until about a year ago, there wasn't any significant exploration. Now we expect that there will be discoveries. But even when we are not going to see the evidence of that in production for many years, because the lead time from that discovery hold the first production is minimum of a decade. Seniors are starting to realize that they needed to replace the reserves. The producers have done a great job of running their businesses. As businesses over the last half a decade or so, they have harvested their assets extremely well, kept their cost contained, generally really strong returns, return capital shareholders, deal leverage. The industry has effectively net zero debt right now, so the balance sheets are really strong. But what's weak is the foundational element of the businesses, which is the reserve profiles, which are all declining, and production profiles, which will inevitably decline, given where the reserves have led over the last 6 or 7 years. The scale is extremely important. Diversification of the portfolio is extremely important, and that's been evidenced in what's happened to Gold Corp shareholders since then, if they held on to the stock, because it was a stock for stock transaction at Newmont's peak value, which was $70 odd. Gold Corp shareholders realized the 3 times return on that investment. The industry's never been healthier. It's run in a very disciplined fashion, more so than it ever has been, with a focus on margins, returning capitalist shareholders. And now we have to start to devote capital to development, as per David's thoughts. What will drive sentiment positively for the sector is the additional discoveries. Discoveries are important to demonstrate that you are growing the value of your business in the ground, finding value in the ground that people didn't know it existed and creating that value in the marketplace. That's an overall exciting element that's been absent for the last half a decade or so. So there's going to be growth and value of businesses, not just harvesting and returning capital assurance. That's an important element, but that's an exciting element for gold equities going forward. And the gold price is taking a breather, but nothing goes up in a straight line. All of the elements that have driven gold to this point will continue to drive gold going forward, which is the low interest rates, quantitative easing, the undermining of fiat currencies, which has driven capital to gold in the past. And today, there's more ways to play gold than there ever has been for general investors. David suggests that you can buy the physical ETFs that didn't exist. 20 years ago, it was very hard to buy physical gold. Now, it's very easy to do that. So it's much more available to generalist investors than ever has been. So guys, this is the end of this video. If you found this video informative, then please make sure to like this video, subscribe to our channel. I'll meet you in my next video. Till then, enjoy.